Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Today, I have on a fantastic guest who is an industry thought leader and managed futures portfolio manager to discuss uncovering and investing in trends. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. It is an honor to welcome Katy Kaminski. Katy is the Chief Research Strategist and Portfolio Manager at AlphaSimplex Group. Katy, thank you so much for coming on. It's really an honor to have you on the show. Thank you for taking the time. Can you just tell us a little bit more about yourself? That bio was very short. I want to get straight to the point so we have, time to pick your brain about managed futures and trends, yourself and AlphaSimplex.
Yeah. First of all, I'm so excited to be here to talk about trend following, which is, I guess that's a good intro for me, is that I've been in the trend following space for my entire career.
Okay.
I have a background. I'm originally from Tennessee, but I was a math geek. So I ended up doing a Ph.D. in quant at MIT, and then have been in the quantitative finance space my whole career. And I love systematic trading, and that's sort of what I like to specialize in and what I've studied and worked in for my whole career. So, when I introduced also AlphaSimplex is a quantitative investment manager located in Boston. We specialize in systematic strategies across many different asset classes, including particularly highly liquid futures, forward contracts, and cash equities. And our core strategy that we trade, one of the main strategies we trade, is managed futures or trend following.
Fantastic. So Tennessee, yeah, I was just there. There's so much more to Tennessee, but obviously Nashville.
I'm from Nashville.
Are you?
The capital,
okay.
the capital.
Yeah.
The
country
seems
music
to be the happiest place on earth these days.
Yes,
Everybody loves it. So
that's fantastic. I've heard it's changed a lot over the years, though.
Totally different. I grew up there, and it's just gone wild. Like
Yes.
It is. Everybody loves it. The music. It's a fun place to go back and visit. And I've been a Bostonian for a while now, so I always head over there sometimes. Yeah.
Yeah. Just real quick, when I went to Nashville, after like 2 days of going to the honky tonks and stuff, I went to my friends. It's like, can we just go to a bar that's quiet, maybe, and like not a bunch of it? It's like they look at me and like, Ryan, how old are you? So
it is wild there. There's a lot of stuff to do, and there's a lot of great music. So
that
part is fun, but I can see how eventually you might want some quiet.
Yeah. So back on track. So can you please start by explaining what is exactly trend following?
So what's exciting about trend following as a strategy? Trend following is an approach to following trends across markets using data. So what we do is bring in lots of price and volume and different information and correlation to measure where the markets are moving. So when we build a trend portfolio, we look at all the possible assets that are highly liquid, and we measure what is the prevailing trend based on price information, and follow those trends as they both grow, recede, and change direction. So let's just take a simple example right now. A couple trends we've been following that are a little more esoteric. Gold has been moving a lot recently. Also, things like cocoa prices have been through the roof. They were up 61% last month. A trend following strategy is really about measuring where the market is going and following the market as the market tells us what's happening next. So it's a very different approach, very technical based, but really purely based on data.
Okay. Interesting. Glad you brought that up, because a lot of asset managers, yes, they say they are trend following, but trend following doesn't mean the same thing from asset manager to asset manager. Some are macro driven, or, so yours is more data driven, like you said.
So one really cool thing about trend following from a systematic perspective is that we are following all of the global trends the same as a global macro manager. It's just we're getting into those trends based on a data-driven approach. Many people don't know that global macro is actually 50% correlated with trend following because we're in the same trends, but our entry and exit points are a little different.
Okay.
Global macro is about picking tops and bottoms and finding the movements. Trend is about measuring confirmation in the trend and following it as those trends continue to build. So it's really more about having a data-driven approach instead of being a specialist on sort of what those big global trends are going to be, because sometimes that's really hard. And it's very hard to actually get that trend right from a fundamental perspective. But markets do move a lot, and during stress, they move more. So having a trend strategy is sort of a data-based way to get that global macro exposure without taking specific views on lots of key global macro events.
Right. Very interesting. And just that macro environment is just so fluid right now, and uncertainty with what's going on with the Fed and global politics. It's yeah.
It's
Oh,
hard, right?
yes,
It's
exactly.
hard to make a call on all of these
Yes.
things. And I think our view is we let the market tell us where those trends are going, and we try to capture them using data.
Right. And can often say data doesn't lie, right? Follow the data. So how do you build a trend portfolio?
So when you think about trend, it's a lot like an opportunistic portfolio. You
Okay.
want to find exposure to as many possible trends as might occur in the markets. So we build a portfolio by allocating equal opportunity to equities, currencies, fixed income, and commodities. And within each of the assets we trade, the size of those trends is going to be risk adjusted to the volatility of each of the assets. So, for
Okay.
example, if we take energy, which has been moving a lot recently, energy is a wild asset, right? It moves a lot. You don't need a lot of it to get an exposure to that trend. So we measure the risk of all the assets we trade, then we size our positions as a function of the strength of the trends with the risk of each asset in mind. So short rates are not very exciting, but still interesting,
Yeah.
risk adjusted. And energy or even the yen are also interesting assets that you need to think about what's the right sizing of that particular trend as a function of where markets are moving.
Interesting. So you cover then your portfolios, all the different asset classes, not just equities or fixed income or commodities.
Our portfolio moves over time dynamically. And from one year to the next, we can see risk and positioning change both in direction and also in concentration. So, in a year like right now, we're seeing much stronger signals in commodity markets and equity markets. And we've seen more mixed signals in the fixed income sector and currency sector. So, as those trends change, the risk in our portfolio moves with them, which allows you to kind of follow those overall trend themes as they move over time.
Interesting. So how do after COVID and stuff, the correlations between equities and fixed income, they increase. So, and they're telling different signals. How do you then discern those different signals that aren't normal? When you look at history, that's just not normal. How do you go about those time frames and in
So, this is a great question because, again, it goes back to measurement. We are measuring correlations and relationships between assets on multiple different frequencies to understand what is the current market view of correlations. So, interestingly enough, two key facts. Number one, bond volatility has been almost double since last year and since 2022. So it's much higher. Number two, we're seeing positive correlations between stocks and bonds on average over a sustained period of time. So you build a different portfolio when the world is focused on inflation. What that means is the world is focused on inflation when bond stock correlations are positive and you're seeing higher bond volatility. That's a different world to trade in or to think about positioning
Mhm.
than sort of your long-term correlation estimates.
Interesting. Yeah, and like you said, it's very fluid portfolio, right? You can't be static because the environment's not static. Everything is changing, especially now. Things change more quickly. Market moves quicker than ever, and um, so very interesting. I think this might be an obvious question, but why is it important to follow trends when you're trying to uncover opportunities?
Well, the interesting thing about trends is that they're always obvious ex post. So after the fact, it's like, well, of course, yields went up. But before you start a yield hiking cycle, it takes people, this is an example, takes sometimes the market time to really sort of rationalize change. And in these moments of change, we will see trends that are measurable in the markets that we can follow that provide very diversifying opportunities. Let me give you two trade examples, which are my favorite. You talked about COVID. Um, COVID was, first of all, we love crazy environments. We
Okay.
love macro uncertainty. And when things are wild, we're at our best. So COVID was actually a very positive environment for trend
Mhm.
because we saw long bond positioning working really well as a risk off. And also short energy positioning was also extremely strong in COVID. Then in 2022, which was also really hard, guess what? We had opposite signals,
Yeah.
short fixed income, long energy. So it just shows that the trends are always changing and they can go up and they can go down, but it's really following those themes before you realize what they are is about being active in those trends as they occur to actually capture them before it's too late.
Yeah, I often say when there's times of crisis, there's opportunity, right? And sure, investing is easy when the tide is raising all boats and everything, and everyone's happy. But it's those times of crisis you find opportunities and maybe more inefficiencies in markets, and that's really where you can separate yourself in this. So what when you talk about trends, what time period are you looking for? Is it longer term? You talked about, COVID and 2022 and the trends you saw there. What's your time period?
So it's funny, we're very short-term nature
Okay.
in that we're often thinking a year or less in terms of how we're thinking about market moves. And if you imagine compared to other investors, that's a very different time horizon. So what that means is that within, short periods of time, if the winds change in the markets, we will be moving with that. Of course, changing trends is not an ideal environment, but as those new trends develop, you're getting into them as they expand. So, an example would be the end of last year. We really have seen a sea change in fixed income. It's still not clear yet where we're going, but we're going to be following those changes in a much more shorter term than some of the longer term, more fundamental investment strategies.
Great. So when trend following works and maybe when doesn't it work, right? It's kind of like sometimes it works really well, sometimes, yeah, maybe it doesn't.
Well, I love this point because when I started in this industry, it was after 2008.
Okay.
And I started in trend following in 2008. And 2008 was a phenomenal year for trend following. And I was puzzled. I thought, like, what is going on? Like, why does this strategy work? So I actually spent most of my career studying, like, why does managed futures work and when? And what the conclusions I've come to, and some of it comes from this term crisis alpha that I came up with many years ago, but also I like the term macro uncertainty. So
Mhm.
any type of environment where there's change, disruption, and dislocation, which is in some sense challenging and difficult, that's when there's more coordination in markets and trends are much stronger. The challenge for most investors is it's really, really difficult to make decisions in a moment of stress.
Mm.
Thus, that's why we lean on a systematic process to make those decisions using data, because ourselves, it would be very difficult to make those choices during COVID, for example, to short energy, to be long bonds. it's hard to make a call in a moment of dislocation. So we tend to do well when things are challenging, in defensive environments.
Just you brought up crisis alpha. Um, I've noticed you coined that term. I've heard you say it before. What does it mean so our audience maybe gets a little bit more understanding of what you mean by crisis alpha?
So for me, crisis alpha, and I've gotten a lot of discussions about the term because some people like it, some people question it
I
because
love it. I think it's
they
great.
well, I love the term because it's a way to explain that we like crisis. And I think so crisis alpha means opportunities during periods of stress or dislocation.
Okay.
And what was interesting to me about this term is, to me, it's much more pluralistic. It's anytime there's challenge, there's crisis. It could be a crisis in energy prices,
Okay.
could be a crisis in fixed income, like we saw in 2022,
Yep.
could be a crisis in equities. But whenever markets are challenged, it's really important to move with those markets, because oftentimes it's really hard to tell where things are going when things get challenging. And so we have tended, our strategy is one of the few strategies that does reasonably well, or tends to do well during those periods. And that's what was interesting to me about that term, is it's a way to kind of explain that, it's a strategy that is very offensive when things are very defensive. So you like the joke about talking about teams right now. It's sort of like it's a defensive offense, offensive defense. So something in your portfolio that loves things that go wrong, is kind of a way to put it.
Would you classify, kind of like a hedge fund, or where you're hedging, against obviously something bad, right? It's your insurance play, but not totally insurance, not like,
So I tend to push back on the term hedge. The
okay,
reason is, hedge gives sort of a sense that you're guaranteed something. Whereas I think of it more like a basketball team. You want to have really strong defenders, so that when you're actually on your defensive end, you have somebody that's stepping up. Now,
mm,
are you going to stop the ball? Not necessarily, but you're going to try. So you at least have a strong defense, something in your portfolio that has the ability to do something in a moment when you're defensive. That's probably a better way than a hedge, because
okay,
the term hedge, oftentimes hedges have an implicit cost.
yeah.
And second of all, they have an implicit guarantee. And in investing, there's really very little guarantee. So that's just my general view. So
Yes. No, that's a very good. There's that connotation that goes along with hedge, right? And I think that's exactly what you just said and that makes complete sense. And when building a portfolio, you want each one of your managers to fill a role, right? And manage futures, and your product, fits that role of defense and limiting downside and so on. So you mentioned managed futures. You're a managed futures portfolio manager. So how does that fit into a retail investment portfolio?
So what's interesting about managed futures, and I just make a point right now about retail investing in managed futures, this is actually a new area for retail investment. Most people are unaware that managed futures as an industry is one of the largest hedge fund categories, and only about 5% or so of the assets in managed futures come from the retail space. So many institutions use us in exactly the way that I described, for risk mitigation, defense in their portfolio. So the way to think about using managed futures is precisely that, in that you need to have something in your portfolio that isn't based on fundamental views, that can't go wrong when that can do something else when all the fundamentals don't work. And so I think about managed futures as a diversifier in your portfolio, that is something that is different, something that's philosophically different, and also that bases its decisions based on a different process than other investments.
Great. And like you said, for retail investors, this space may not have been accessible 10, 15 years ago, right? So now that's what's great about all these different products out there, investment vehicles, is now retail investors can now get access to these strategies that were once earmarked for the Yales and the endowment funds and so on. So it's fantastic. It really helps creating more diversified portfolios and helping investors achieve their goals. You talk about risk management. How do you think about risk management when it comes to managed futures? Is it, obviously I would think it helps mitigate risk.
So when we think about risk management, actually, I would say that everything we do is obsessed with risk. We
Okay.
do everything we can to think about risk. So let's talk about a couple different areas. One is how we think about risk in our investments. So when we size our positioning and everything we do, we think about as an opportunity.
Hmm.
But each opportunity is sort of a unit of risk. So like energy is really volatile. So you just need a little bit of it to get an exposure.
Yep.
Same thing with short rates. They're very boring, but still an interesting investment, but you need more of them to
Right.
actually see the return. So because we trade in the futures markets, and many people don't know this, our portfolios are roughly 85% cash and about 15% collateral for positions that we take, which is risk exposure to different global markets. So if you look at our balance sheet, it's mostly cash that's earning a yield. And then the position and all the risk is in futures contracts, which are sized depending on how risky each of those assets are.
Hmm.
So all of our portfolio design and decision making has to do with measuring how much risk in each of the positions we take and how does that come together. So risk management is really where we start as opposed to forecasting a view. Number one is
Hmm.
what are the risks? Where should we balance? Then we should size those risks appropriately compared to the opportunity set. So that's more sort of the risk from inside a portfolio manager's day to day. Now, when it comes to risk of investing, so let's step back for a second and talk about risk of investing in managed futures in a portfolio. Managed futures has a very stable risk profile because we manage that, but the positions and the direction are going to change over time,
Hmm.
but we tend to be relatively stable in our risk. So for example, when vol spikes, we're pretty much similar to the risk we had the day after. Even when you have a COVID type event, we are measuring that. So when you're thinking about adding managed futures to a portfolio, you need to think about balancing that particular portfolio, that position, with your more fundamental exposure, and combining those together, because over a long term we have negative to sometimes and sometimes positive but overall zero correlation to your other investments. It's about kind of combining that to improve your overall portfolio.
Interesting. So when you talk about risk and measure, what metric do you use to measure risk? Is it just like basic volatility, like standard deviation, variance? Like what do you use to actually measure risk?
So we measure risk over multiple different windows and horizons, including intraday, daily, multiple windows, and we use all of these estimates together to give a view on the overall risk profile of each asset that we trade. We then use those metrics to understand, once you combine, including the correlations of the assets we trade based on multiple measures as well, what is the overall risk profile of the program. So that, let's say you have a 12% volatility typical range, that's going to vary around 12% all year. And you'll probably realize something pretty close to that. But what you're trading is going to change over time, what's in the portfolio, but the risks are all going to be measured so that they come to the right level of risk.
Fantastic. Awesome. Katie, that was really great. Learned a lot. Such a fun conversation. Uh, Anything fun going on? I like to always end the conversation with something fun. It could be market related, anything with March Madness, whatever, anything fun.
I'm just excited about basketball right now too, just like you. In that, I was telling you earlier, my daughter was winning some for her brackets, and I've been very excited about that. But it's been making me I was using this analogy with a offensive defense
Mhm.
again, and I love that analogy. And I'm thinking, like, that's such a good analogy for right now because we're all watching these games. And
Yes.
so I'm excited about basketball. We're a basketball family. So,
Awesome. It
so
is a good time of year. I like football better, but this time of year, and then you got the start of baseball and in spring. Yay, we finally get some spring and sunshine. And
hopefully.
it is a good time of year. Definitely. So Katy, thank you so much for coming on the show. Really, it's such an honor to have you on. It was a great conversation. I learned a lot. You dropped a ton of knowledge. So thank you. Where can the audience get more information about AlphaSimplex?
So we have a lot of educational and thought pieces on our website, some of which I've written, and of course they can definitely email us. But on our website, alphasimplex.com, we have a ton of information about thought pieces on managed futures in general. So definitely go there.
Yeah, I've read a lot of that getting ready for this conversation, and there is a lot of great content there, and stuff I had to read a couple of times. Like, like what is very good thought provoking thought leadership. So, thank you so much for coming on. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.